Let's get more on this with Steve Keen, visiting scholar at the University of Amsterdam. Hello there, sir. It's good to see you. So pretty interesting to see some blowout profit numbers from the major banks this quarter, yet CEOs striking a cautious tone. What is this? What can you say? Is it a classic case of, I don't know, good times, bad outlook? Or maybe is there serious concern that this conflict could derail everything?
Well, this conflict is destroying the physical production basis of the global economy. So, of course, it's going to have a large impact. And I think the estimates the IMF made here are laughably small.
Well, Professor, when you hear Jamie Dimon, head of the largest bank in the US, speaking as bluntly as we just heard, how much should average investors be worrying about their portfolio right now?
Well, extremely, because if you don't have energy supplies, then your GDP falls 1 for 1. And I strongly suspect, by the way, that the mathematics behind this IMF report assumes that if there's a 10% fall in energy, there's a 0.5% fall in GDP. Not 1 for 1, but 1/20th for 1. So I think the estimates that we're being given by these official bodies are far lower than what we're actually going to experience. And there's every right to be thinking in panic terms about this, and don't rely upon economists to give you guidance about what's likely to happen.
Professor, we're hearing a lot of about banks like Wells Fargo holding extra cash as a buffer. What does that say to you about how they're preparing for potential economic slowdown compared to just a few months ago?
Well, they're expecting lots of firms to be unable to pay their debts. And of course, this will apply to a lot of working class Americans as well, and other working class people around the planet. When they suddenly find they've got a budget virtually twice as much for petrol, they won't be able to service their mortgages and they'll go bankrupt. And this is when you put aside cash, really, what you're doing as a bank is putting a lot of provisions for bad loans, so that when the hit comes, it doesn't destroy your overall positive net worth, which banks are required to maintain by law and by the sheer practice of what a bank actually does. So this is showing that the banks themselves, I think, are treating this crisis more seriously than economists and the IMF are doing, and that's a good thing.
And Professor, with inflation proving to be so sticky because of energy prices, the dream of interest rate cuts seems to be fading, I guess. If the Fed has to hold rates higher for longer because of this war, what does that actually mean for the everyday borrower?
Well, it means that the economists don't know what they're doing. The last thing they should be doing is putting up rates right now, because what that does is squeeze people's capacity to pay their debts, when the increase in the price of oil is going to also squeeze their capacity to pay their debts. Banks should be doing the opposite right now, dropping interest rates, because that's what you do when you expect a serious damage to the global economy. That's what happened during COVID, for example. Central banks were dropping rates, they weren't putting them up. This is typical neoclassical economists responding completely the wrong way to a crisis like this. It's not a case of trying to dampen demand. Demand is there because people need to get to work. If you make it more expensive for them to do it, then they don't get to work and the economy suffers even more.
Typical indeed. Professor, great connecting with you. That's Professor Steve Keen at the University of Amsterdam. Have a great day. Thank you.